the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how Singapore markets closed for the day, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares fell today as optimism over the US-China tariff truce faded away. So the Straits Times Index was down 0.39% at 3,865 points at about 1:43 p.m. Singapore time, and we're looking at a value turnover of some 703 million Sing dollars in the broader market then. Now, off to the closing numbers, the STI down 0.26% at market close. We're looking at 3,871 points. In terms of value turnover, that's 1.34 billion Sing dollars. Now, gainers outnumbered losers, though 279 versus 229. Top advances for the day we've got for you, HPL, Food Empire and Jardine Cycle and Carriage, and top decliners we've got SGX, OCBC and iFast. Now, in terms of counters to watch, we've got for you Food Empire, one of the top advances for today, because the company posted a 16.3% rise in its top line to $136.6 million USD for the first quarter ended March, as most major markets delivered better performance. Now, elsewhere, from the impact of a $600 billion US investment by Saudi Arabia to Microsoft cutting 6,000 workers across the company, we've got more international and corporate headlines in focus. And joining me on the line today is Eddy Loh, Chief Investment Officer at Maybank Group Wealth Management. Eddy, welcome.
Hi, Tintin.
Great to have you join us. And Eddy, let's start with the US this time around. We're seeing a couple of things weighing on markets overnight, so let's unpack them one by one. The first thing has got to do with Saudi Arabia pledging their $600 billion USD worth of US investments in a range of sectors from defense to AI, and US President Donald Trump said the agreements include a huge deal for NVIDIA and AMD, and that will boost US jobs. It will push the stock market a lot higher. How would you read into the deal, and what would the deal mean for sectors set to benefit?
Well, this deal is definitely pretty significant, much more significant than what Trump managed to garner during his first term. So, in fact, if you look at the details, there is actually a historic $142 billion defense sales contract, which is nearly double the size of Saudi Arabia's 2025 defense budget. And then as you mentioned, the likes of NVIDIA and AMD will be supplying advanced AI chips, in particular, I think, to a new startup AI startup in Saudi Arabia. I think it's called Humane, which aims to build a 500 megawatt compute capacity data center. So obviously, the key beneficiaries, not surprising, will include the AI and semiconductor companies, defense contractors as well. In fact, following the announcement, we saw NVIDIA share price surging over 5%. I think that reflects a certain level of investment optimism about this announcement. So I think apart from providing companies with new markets and revenue streams, the deal is also expected to create high-quality jobs. And in addition, I think it also can potentially enhance the strategic ties between U.S. and the Middle East and Saudi Arabia, which actually comes at an interesting time amidst all the troubles that we are seeing in the Middle East. And in some ways, it can also help to restore President Trump's approval rating, which has actually did quite a fair bit ever since his handling of the trade tariffs and the economy.
At the same time, we talked about the economy, Eddy, we've got cooling inflation data out of the US last night, which provided investors some relief, but analysts said, the impact of Trump's Liberation Day tariffs that will likely only be seen in May's readings. So again, back to the usual question that we asked, right? How far can we rely upon, and how far have Wall Street investors relied upon the latest reading out last night then?
Right. I think if you look at the April CPI, it came in at 2.3% year on year, slightly below consensus estimates of 2.4%. And I think in some ways it partly reflects the demand concerns stemming from the heightened tariff uncertainty. Now, we do expect CPI to move higher with the effects of tariffs kicking in. in subsequent months. I think I've seen estimates saying that, because while there is a pause on the reciprocal tariffs, we still have this baseline 10% tariff, and that could potentially add an estimated 0.5 to 1% to U.S. overall CPI. Now, by having said that, we do not expect to see a repeat of the kind of inflation surge that we witnessed during the post-pandemic era in 2021, 2022, right, where CPI soared to 8 to 9%. Right, so in fact, I think at this juncture, we think CPI for the full year maybe will remain around 3 to 4%. So I think that will allow the Fed actually to ease and cut rates again, as the growth concerns are likely to outweigh the inflation risk.
Okay, and Eddy, going back to the Singapore stock market, how did the STI fare today? Any surprises when it comes down to the biggest movers and the sectors that they lie in? Because I think Asia as a region struggling there to maintain that positive momentum. Would you say so?
Right. I think there was a bit of a profit take or a bit of, fading optimism after the U.S.-China trade truce. So we saw STI slightly lower. Most stocks are in the red. Only a selected few defensive stocks in the green. I think what caught our eye was really the REIT sector. They were most of the REITs were actually lower. And that is really on the back of the higher Singapore government bond yields. If you take notice, the 10-year Singapore bond yields has actually risen from just 2.4% to about 2.6% in just 2 days. And I think that's in tandem with higher treasury yields that we've witnessed during the same period. So as investors, we know that there is actually negative correlation between yields and REIT prices. But, if you take a look at the valuation, Singapore REIT sector now is offering yields of about 6.4%, more than 6%. So we thought that it could be an interesting opportunity for investors to lock in some attractive yields.
Okay, and if we could zoom in on some of the companies to watch for today, Eddy, we have Food Empire, one of the top advances, in fact, up over 11% at the close, because Food Empire posted a 16.3% rise in its top line to $136.6 million USD for the first quarter ended March, as most major markets delivered better performance. I know you don't comment on individual firms, but generally speaking, are there any clues we can pick out on how packaged food manufacturers or consumer-facing companies are faring?
Well, if you take a look at the packaged food industry, there are some structural factors that are supporting the demand growth. Demand for more convenient food, ready-to-eat products, driven by lifestyle changes and rising income, especially in Asia, in this part of the world. And unlike cyclical sectors, demand for consumer staples, including the likes of packaged food, tend to be less elastic. So it's often actually seen as a defensive sector to seek shelter amidst, especially when there is actually increasing growth or recession uncertainty. But having said that it is actually nevertheless quite a competitive industry, so the likes of Food Empire continues to face quite a fair bit of competition, and there are always headwinds in terms of cost inflation, as well as regulatory changes when it comes to health requirements or even environmental concerns. So I think as a company in the sector, those that can actually, innovate in terms of product offerings, in terms of packaging, as well as manage their costs effectively, are likely to emerge better, in a better position down the road.
I see. Now, if you're just tuning in, we're now in conversation with Eddy Loh, Chief Investment Officer at Maybank Group Wealth Management. One another company that we want to set our sights on, Eddy, is BRC Asia, which is a steel solutions provider. Now, BRC Asia, yesterday, it reported a 9% year-on-year increase in net profit for the first half to 42.1 million Sing dollars. That is from 38.5 million Sing dollars in the year-ago period. Again, broadly speaking, what do you think is the outlook for companies in the steel and aluminium industry amid what seemed to be cooling global trade tensions? Do you think there'll be more reprieve for those in the steel and aluminium industry, especially when we look at the auto sector as well?
Well, different usage for steel and aluminium. Yeah. Steel is more for infrastructure, construction, aluminium more for transportation, electronics. So if I were to zoom in into steel sector, I think it is actually quite a challenging sector for investors. Overcapacity has been a persistent issue for many of the players. Like, for example, in fact, China, one of the biggest steel players in the world, right, has been facing ongoing challenges from weak domestic demand because of the sluggish property market, as well as moderating infrastructure investments. Now, but come this year, actually, if you look at some of the industry reports, there are projections of lower steel supply in 2025. And cooling trade tensions, I think that could also bring about some relief and support demand recovery for steel, although I think bearing in mind, while President Trump has actually paused the reciprocal tariffs, there is still this 25% tariffs on aluminum and steel imports into the U.S., right? But I think on the brighter side, in terms of demand, what we are seeing is also governments around the world looking to increase fiscal spending to support growth. For example, Germany is looking to increase infrastructure spending, which is going to be supportive for steel demand. And closer to home, I think the Singapore's construction sector is also expected to maintain steady amid a healthy pipeline of public infrastructure projects. So I think that should actually bode well for steel players, including the likes of BRC Asia, as you have mentioned.
And finally, before we let you go, Eddy, big news of the day, Microsoft saying that it will cut 6,000 workers across the company in an effort to reduce management layers. So a spokesperson said the planned terminations will amount to less than 3% of the total headcount. It will occur across geographies, employee levels, and include LinkedIn. Does this spark any concern regarding the performance of tech giants, especially if we view that against the backdrop of massive AI and massive data center spending?
Well, I think many times when we hear about such layoff news, I think it always raises some eyebrows, catches some attention, but really, we do not think that it reflects anything fundamentally negative about the company. Rather, it is quite a common industry practice of how companies are trying to optimize their workforce to really spearhead or support their long-term growth. And in fact, we have actually seen or witnessed similar cost-cutting measures at other tech giants such as the likes of Google and Amazon, which have also been restructuring, laying off some employees to control expenses, and at the same time prioritizing and reallocating their resources to other areas of growth such as AI development. And one of the key things here is actually we notice a lot of these mega tech companies, including the likes of Microsoft, have recently reported pretty robust financial results in the first Q earnings reporting. So I think that actually indicates that the structural growth story in terms of cloud, in terms of AI, I think is still quite intact for many of these companies.
I see. Lots to unpack indeed, and I suppose lots to watch in the coming days. Thanks so much for the insights as always, Eddy. That was Eddy Loh, CIO, Maybank Group Wealth Management. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.